Hey, what's up, everybody? It is Thursday, August 22nd. More evidence today of economic softness, economic slowing, however you want to call it. We had an uptick in initial claims for unemployment benefits. That was up 4,000 to 232,000. Last week was revised up to 228,000. And we had Chicago National Activity Index at minus 0.34 compared to June was minus 0.09. So more evidence of economic deceleration. The market was down. I'm not surprised on that, but I'm going to call today a throwaway day. And the reason I'm calling it a throwaway day is because everything could turn around very quickly tomorrow. Powell is speaking at the Jackson Hole Symposium, and if he gives the market what the market is hoping for, which is a dovish leaning on monetary policy, the market's going to go right back up. So as you know, it's crazy to look at these day-to-day fluctuations. A lot of it is noise. I happen to think today's sell-off was tied to the reality that the economy is slowing down, which is a theme that I've been laying out here in these videos for a while now. And all the data progressively is showing more and more of this deceleration. So I'm not surprised by that. However, you know that right now, everything, well, not even right now, but like most of the time, nearly always, in the short term, things are driven by the monetarist zombies. And if Powell comes out tomorrow and indicates a rate cut, even if that's a basic, the incremental 25 basis point, if he, tees that up, then the market's going to pop right back up, and today's sell-off is going to be erased. So you really have to, again, this is a lesson to you guys that I cannot overemphasize. You got to step back. You got to have perspective, and you got to really be disciplined to try to focus on the forward outlook. What will forward conditions be like? Because that is going to determine the trend. And when the trend of the economic trend, the trend of the economy, which will determine the trend of your assets, okay? Not just stocks, but I mean stocks, bonds, real estate, currencies, commodities. That's what you got to be focused on. And that doesn't change every single day. Like, back in 2022, in the fourth quarter, when I was saying, you got to buy this market, these interest rate increases are going to translate into a major fiscal expansion with the transfer of interest income transfers into the economy. And that did not change for the entire period. Now I'm telling you I see things now that give me some caution. Number one, the rate cuts themselves. Okay, I've been talking about this for a while now. The rate cuts themselves are going to do the exact opposite of what rate increases did, where rate increases increased those interest income transfers into the economy substantially. I mean, we're close to $1 trillion now, okay? I mean, that is, significant is not even a strong enough word or adjective to describe that, all right? So you had that phenomenon. Now the rate cuts are going to do the opposite, slowly at first. I'm not saying it's going to take away that trillion immediately. It's going to start slowly over time, but we're already seeing another thing that I've been telling you guys about is that the net transfers to the economy, that is the leading spending flows minus taxes take away some of that is down year over year by 250 billion. when the Fed starts to cut interest rates, it might take 2 or 3 or several interest rate cuts to start to, get that downtrend in the year-over-year transfers to get bigger. But nevertheless, that's what's going to happen. That's number one. That's the first thing that is bothering me. The second thing is that as we come into 2025, first of all, we're going to get through the election. We don't know who's going to win. Whoever wins is going to start to formulate their economic policy. I mean, there's stuff out there right now, but right now that's campaign talk. Okay, that's campaign talk. We don't know whoever gets elected, whether it's Trump or Harris, what the exact policy proposals are going to be. And once they are proposed, they got to get through Congress. Okay, and we don't even know how Congress is going to flesh out in the election. So there's no sense thinking about that right now. But I can tell you that next year in 2025, the cost of living increases for Social Security. I talked about this yesterday. The COLAs for Social Security, Medicare, Medicaid, military pay, veterans benefits, all those are going to be much lower than what they got this year and much, much lower than what they got in 2023. Okay, that's number one. Number two, the Trump tax cuts expire. Now, again, we don't know if Trump gets elected. He might very well extend those tax cuts or even add some additional tax cuts. We don't know. I can't speculate on that right now. The only thing I can tell you is that is set to expire. So you got the rate cuts, okay? You have the slowdown in the COLAs for these programs. We're already dealing with, so what does that mean? It means fiscal drag is going to increase. All right, fiscal drag, think of fiscal drag like the brake on a car. I've used this analogy. Your car's going along very nice. You slowly start to step on the brakes. You're not jamming them on. They're not balancing the budget by some real draconian means or anything like that. It's a slow process, but what happens when you start stepping on the brakes? Or better yet, what happens when you just take your foot off the accelerator? That alone, it starts to slow the car down. But let's say you're doing both because you got the accelerator, which is the spending that's going in, but now the brakes are coming on a little bit harder next year. You're dealing with an economy right now with these massive transfers that's only managing to grow barely at 2%. Okay, it's not like we're talking about it's growing at 6, 7, 8% and it's gonna slow down to 6 or 5 or 4. We're talking about an economy where the leading spending flows are over 7 trillion, okay? And you're barely making 2% economic growth, and now you're going to be stepping on the brakes, even if that's a little bit. Okay, I'm not saying that they're going to slam on the brakes. I'm just saying I just pointed out some things to you that are going to happen. I mean, these cost of living increases are they're going to be less. All right, the rate cuts are going to start to siphon some off. What happens if the Fed doesn't cut rates? Somebody asked me this today, and I thought that was a good question. He said, Mike, if they don't cut rates, doesn't that sustain the economic growth and sustain the stock market rally? That's possible, but I'm still saying that we have the adverse effect of what I call the reverse stabilizers, all right? Like what's causing the shrinkage in these net transfers, okay? Because we didn't have spending cuts. Actually, spending is up $100 billion over last year. What's causing this shrinkage? The shrinkage is being caused by a phenomenon, which I've explained in the past. It's the opposite of the automatic stabilizers. The automatic stabilizers are when the economy goes in recession and you have more people filing for unemployment benefits. You got people taking Social Security, Medicaid, all these programs. It acts as a safety net and it just automatically starts to expand spending to the point where it stops the downturn. Okay? That's why they're called automatic stabilizers. Well, on the upside, when the economy is growing, you have the opposite effect, that the more or the longer or the faster the economy grows, the more it starts to kick off these tax deposits to the government. It's like a siphon. It's like draining off some of the water in the swimming pool, okay? And that is the reason why we haven't had tax increases and we haven't had spending cuts. So the answer to why are the net transfers shrinking, it's because these reverse stabilizers, tax deposits, are growing a little bit faster than the spending, okay? And that is what is kicking in now, and that's why the economy has slowed down to barely a 2%. So I'm saying, like, remember, I started this video off by telling you guys, you got to look ahead, all right? You got to try to ascertain or determine what is the forward outlook for economic conditions. That is going to tell you everything. It's going to tell you what investments, how to position yourself, what the trend is going to be. That's what you need to know. Not this one day I'm selling, one day I'm buying, one day I'm selling. The Fed said this, the headline said that. That's crazy stuff, man. You got to do this. You got to do it this way. And this is what I try to help you with. So I'm telling you right now. So the question was asked, Mike, what happens if they don't, if first of all, if the Fed doesn't cut rates, the stock market's going to go crazy, at least temporarily on the down, because the monetarists are like, it's almost like they're crawling across the desert in 130-degree heat, and somebody's been holding out a cup of water for them, and they barely have any life left, and they've been crawling and crawling and crawling in the blistering hot sand, and that person, here's some water, and as soon as they get there, he takes the water away. So imagine, that's like you die right there. So if the Fed did something like that, I mean, the market will, in the short term, it'll tank, all right? Then it'll probably stabilize because, look, if they don't cut rates, what happens? These interest income transfers, they just continue into the economy, which is not bad. We've seen. I mean, that is the thing. Think about it. If you took away this year, $850 billion so far, and we still have another, month and a half, 40 days left to go in the fiscal year, $850 billion, it's going to be $1 trillion by the end of the fiscal year on September 30th. If you took that away, if that wasn't there this year, if you didn't have those transfers there this year, that trillion, I mean, we'd be in negative growth. There's no question about it. We'd be in a deep, deep recession. I mean, that thing's been floating the whole entire economy. So if the Fed doesn't cut rates, which I highly doubt, but let's just go through that scenario, you have that, they're taking the water away right when the poor guy is crawling up to it. The market's going to dive. Then it'll probably come back a little bit. But then you still have these other things that I'm talking about, okay? You're still going to have 2025 when the smaller increases in the COLAs for these programs. You got the Trump tax cuts expiring. We don't know what policies the new president is going to try to put forth, okay? We're going to need some time to see what they are and then assess the impact of that. I mean, for all we know, if Harris gets elected, she's talking about massive new spending programs, but she's also talking about taxes. We have to see, how that adds up. We can't speculate on that right now. The same thing with Trump. Trump says a lot of things, and a lot of times in the end, he doesn't come through on it. All right, so we don't know. We got to wait. So, by the way, once again, please like and subscribe, okay? I know a lot of you have been doing it. I always forget to say that. Please like and subscribe. Thank you very much if you've already done that. You don't have to do it again. It's helping the channel enormously, and I really, really appreciate it. Folks, thanks a lot. So I'm still saying that the economic break, the analogy I just used with the car, we're driving along, we got our foot on the accelerator, but some brake pressure is coming on. And even if the Fed doesn't cut rates, the brake pressure is coming on automatically. It's almost like your car has an automatic, braking mechanism when it reaches, and when I say your car, I mean like the economy has an automatic braking mechanism when it reaches either a certain speed or when it's been riding for a long time, it starts to come on, okay? And that's what's happening. And then you have those things that are going to change in 2025. So I'm saying that we're entering into a period. The reason why I keep saying every day, like, it's going to get fun, it's going to get interesting. It's going to get fun because all these monetarist people who've been dying and talking about rates, that's all they ever talk about, they're going to get it wrong again, okay? That's how it's going to get fun, because we're going to watch and they're going to be squirming around, you know, trying to figure out what the hell's going on. They cut rates and it's not helping. And you know what they're going to say. I said this yesterday. They're going to say, oh, but the Fed waited too long. They're going to say everything to rationalize their error. You know, they're not going to go back and try to rethink and maybe we were wrong about this. Maybe we're looking at this thing the wrong way. Because every time we say something, it's the opposite. No, they're not going to do that. They're just going to make up some excuse. The Fed waited too long. So that's what's going to happen. I'm laying it out for you. I mean, this is why I think it's more right now a period or a time of caution. I'm not telling you go short. I'm just saying it's a time of caution. If you choose to take that as getting out or going short, I mean, that's on you. I'm just me. I play it more cautious. I wait. And when the economy slows down, there's going to be a time, like an amazing time, to buy great companies, and their stocks are going to be way down. And that's how, you know, you do these things. And when you see these cycles, I mean, you talk about building wealth. I mean, this just puts it on steroids, man. This hyper accelerates your wealth building process because you're doing it smart. You're doing it smart, and you're letting the power of the economy, the power of conditions, kind of like put the wind in your sails. You don't have to try as hard. You know, it's like a force in physics. You allow that force to take you to where you want to go, your goals of achieving, you know, wealth. Anyway, that's it for today, folks. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. You know, you need the guidance through this process, we're entering into a new phase, a new environment, a new set of conditions. And if you're going to rely on CNBC, and if you're going to rely on the Wall Street Journal and all these other cockamamie things they don't know what the hell they're talking about, I mean, you're just going to be lost, man. You're going to be lost. And, you know, don't think that, you know, you could just do this on your own, because I got a long period of experience in understanding and then kind of formulating that, processing that into actual strategy, MMT, understanding how the monetary system functions. That's it for today, folks. See you tomorrow. Bye.